Ladies and gentlemen, with the total cryptocurrency market cap at the $3 trillion resistance level, we know, and I've been very clear in recent videos, that this is possibly the most important resistance zone that Bitcoin will have to conquer for the entirety of 2025 and definitely even stemming backwards further into 2024. Months on end, we have not seen a level this important. And all of this is happening on the precipice of the next FOMC decision, the time in which the Federal Reserve will be determining whether they want to be cutting rates even further by another 25 basis points or more, or leaving rates in the same place they are. That's just 3 days away, and I'm seeing massive misconceptions, sweeping misconceptions among popular cryptocurrency analysts, people on Twitter, people in my comment section, about how Federal Reserve interest rates relate to the Bitcoin price. A lot of people are saying that Bitcoin cannot go up unless the Federal Reserve cuts interest rates. And I think this is completely baseless. I don't think we need quantitative easing on any mass level for Bitcoin to go upwards. I'm going to explain to you why in this video in a very brief and concise manner, clearing up some very big misconceptions here, and also diving back into these major levels on the total cryptocurrency market cap and Bitcoin very briefly towards the end of the video. Before we get into it today, guys, we have an exchange here that has never been hacked before in 3.5 years of being on the market. That is global non-KYC. You can sign up from anywhere in the world and use this exchange without a VPN. And furthermore, with my referral link down below, you can get a 15% trading fee discount attached to your account for life, as well as $8,000 plus USDT in trading rewards added to your account as trading bonuses for signing up with my referral link down below. This is big stuff here. It's an excellent deal. I reached out to them for partnership. They did not reach out to me. I don't get paid by them. The only thing I get is a referral link. And if you want all those things I just mentioned, which you should, trust me, I've done the scouting of the market, you can use my link down below to sign up. It takes 30 seconds and you'll get those rewards and bonuses and you'll help out the channel. I appreciate that, guys. Let's get into the content. Let me give you a little macroeconomic lesson to start off the video. Money is not printed from thin air. I know people say that a lot, but it's not exactly true. Money is printed via debt, okay? And it's not actually physically printed in a lot of cases. It's created when the cost of debt goes very low, and the cost of debt going low encourages debt to be taken out, debt which is spent on assets. For example, houses. People take out mortgages from the banks, which is essentially taking out debt from the bank. The bank gives them that mortgage at a certain rate, which is heavily influenced by what the current interest rate is set by the Federal Reserve. All of this is to say, money is created through debt, and when the cost of debt goes down, when interest rates decrease, more money is created than when the cost of debt is higher. So this isn't exactly true, but for the sake of keeping this video simple, we're just going to act as though it is, right? Quantitative easing, QE, is what happens when the cost of debt goes down, okay? And quantitative tightening, QT, is what happens when the cost of debt goes up. The cost of debt going down is synonymous with rates being cut, okay? And the cost of debt going up is synonymous with rates being increased, okay? So fundamentally, when the Federal Reserve decreases interest rates, the cost of debt goes down and therefore assets go up in value because money is flowing directly into assets through debt. And vice versa, when the Federal Reserve increases interest rates, not much new money is being created, hence not much new money is flowing into assets, and hence assets have a harder time going up. So QE, cutting interest rates, is very good for financial markets. And we've actually seen the Federal Reserve begin to do that. The Federal Reserve has cut interest rates. They did it a few months ago, but right now they're pretty set on pausing the rate cuts. And they have been for many months at this point. Right now we have a 97.2% chance of the Federal Reserve not cutting rates any further tomorrow. And they're probably not going to be likely to do it until something like July, according to the market expectations. Now, this is interesting because the 4-year cycle, as per its date range trend, and as per the trends that exist on the macro scale for traditional markets as well, is expected to end in October. Now, if the Federal Reserve is not going to cut rates further until July, the end of July, that only leaves about 2 months between the end of July and October for the market to rise with the rate cuts and for money created through new debt to flow into markets. And so if you had the viewpoint, which a lot of people seem to have, that the market can only go up when we see quantitative easing, when we see new money flowing into the markets through debt, then there's not much time for that to occur at the end of the year, and therefore the 4-year cycle would have to break or it would have to extend. Now, that's the argument a lot of people are making right now. A lot of people look back at the prior cycle in 2020 and they think, okay, the only reason we went up in 2020 so heavily is because we saw a massive cycle of money printing which forced the markets to the upside. Now, of course, that's true to some extent, but it's not fully true. In the case of the S&P 500, it's exceptionally true. The S&P 500 went upwards from the bottom of the COVID drop to the top of that 2021 bull market over 100% in a matter of 18 months, which is absolutely ridiculous for the S&P 500, which usually averages, 8 to 9% per year before that point, or at least before the last decade of price action. So an 100% gain in 18 months is ridiculously large and definitely driven via money printing. And we can see that very clearly just by looking at the S&P 500 chart adjusted for the M2, adjusted for the money supply. And you can see that what was 100% increase on the S&P price chart regularly was only a 63% increase on the S&P 500 adjusted for the money supply. So obviously there was a massive element that drove the market upwards in 2020 to 2021. That element was quantitative easing that existed in traditional markets and also in the cryptocurrency market. But now people have developed a recency bias. They look at what happened in 2020 and 2021. They say, okay, that happened within the context of quantitative easing. And they look at quantitative easing coming, very, very soon, potentially this year, most likely this year. And they think, okay, the market will really start going up when quantitative easing happens. And therefore, since quantitative easing will only be starting towards the end of the cycle, the market will extend beyond the regular cycle length. That's the argument people are making. Now, I disagree with this, and all we need to do, you can't really disagree with something like that, but I'll poke a hole in it. All we need to do is look historically at what interest rates have done in relation to the Bitcoin chart to find out this is kind of a baseless theory, okay? People have recency bias here. They look at 2020 and 2021 and they say, okay, QE happened there, right? Quantitative easing happened there, money printing happened there, and the market went up. Therefore, we need money printing for the market to go up. It's simply not true. Here is the interest rate chart in red overlaid with the Bitcoin chart. Guys, we've only ever seen quantitative easing coincide with a Bitcoin bull market on one occasion, the most recent occasion. The 4-year cycle is much bigger than 2020 and 2021. 2017, which was the biggest bull market crypto saw in a lot of ways, especially for the altcoin market. The altcoin season in 2017 was absolutely ridiculous. 100x's every single day on many massive coins. That happened within a period of quantitative tightening, okay? Not even a neutral market environment. That happened within a period of time in which the Federal Reserve was actively increasing interest rates, and 2013 did not really happen during an intense period of QE either, right? So actually, if we're going off data, only one time has a bull market occurred within a quantitative easing cycle. To act as though we need quantitative easing for Bitcoin to rise, and to act as though quantitative easing is the be-all, end-all that will keep Bitcoin rising beyond its regular cycle length, I think is baseless. I don't think it's based on anything at all. In fact, Bitcoin's been rising quite nicely while interest rates have remained very, very high. And I also think it's quite ridiculous to act like you know what's going to happen with the markets in relation to interest rates when it's been exceptionally well established at this point that the Federal Reserve has acted very strangely since around 2020 with interest rates. The first time the Federal Reserve has ever raised interest rates during a traditional market, bear market, was back here in 2022. This is a unique market environment. They did not act this way before. They are acting in a completely unique way since COVID. So to act as though prior trends are remaining here, I think is also just baseless to some extent. I think to some extent, we don't really know what's going to happen with interest rates in relation to markets. Obviously, take that with a grain of salt. Interest rates going down is good for markets, but there can be an extensive delay. And given the fact we're seeing a new market environment, there could be some sort of change here, which we're just not aware of yet. So no, we don't need quantitative easing. We don't need excessive money printing for Bitcoin to enter a bull market or maintain being in a bull market. It's already in a bull market. And even if we did, quantitative easing is coming. And so if anything, that'd actually be bullish, and it could extend the cycle beyond its current, let's say, use by date, or beyond its expected top date in October. But that's something we'll just have to wait and see. We just simply don't know yet. It's certainly not bearish either way. So with the total cryptocurrency market cap chart at the $3 trillion resistance level, the level that was the daily candle close in 2021 and the wick high in 2021 between 2.9 trillion and 3 trillion, also being a major psychological resistance level because it's a round number, with the market at that level, at the verge of seeing the next leg, at the verge of breaking out from this level or viciously rejecting from it. A lot of people claiming that we need quantitative easing for this next pump to occur. are claiming it baselessly because we didn't need quantitative easing in 2017, we didn't need it in 2013, and we would have seen a bull market in 2020 or 2021 without it. Okay, we know that because even adjusted for the money supply, even adjusted for the quantitative easing, financial markets still rose alone, as per the S&P 500 chart, adjusted for the money supply, 60-something% in a matter of 18 months, which is still ridiculously outperforming a regular market environment. So we don't need quantitative easing for this level to be surpassed. The good news is we'll probably see it anyway. We just might see it very late in this cycle. So I suppose the only thing that could change this cycle is potentially quantitative easing could keep the cycle alive for longer than previously expected. And that might sound very good on paper. Oh yes, more bull market, longer time in bull market, more gains. But actually, I think that would be a negative thing because we don't want the cycle that has defined the Bitcoin price action for its entire lifespan, that is leading to Bitcoin being very, very predictable on a cyclical scale. We don't want that to break because then we are in the dark. Then we don't know what happens next. So in a way, I actually hope the cycle is stronger than whatever quantitative easing could be to come, so that we maintain predictability on Bitcoin, so that future cycles are easier to trade. So a bit of a confusing video, a bit nuanced. I was addressing an argument that is based heavily in the macroeconomic situation and the macroeconomy and macroeconomic trends. And I understand that a lot of people don't have a good understanding of that. So it's kind of hard to bring it to you in a way that is simple and coherent, but also complex enough for it to make sense to people who do understand it at the same time. Basically, to conclude, a lot of people think we need money printing for the market to go up. That's not really true, but money printing's coming anyway. That's a good thing. And that could change some stuff, but we kind of hope it doesn't. That's the too long didn't read there. Bit of a weird video. Sorry about that, but hopefully it was useful to some of you. Guys, thank you for watching. Hope you enjoyed. Please check out the Bitunix Exchange if you are interested. It's an exchange that I've handpicked for myself. I don't just take advertisement deals from random exchanges. I use them first, I test them out, and I've used this exchange for about a year now. In fact, it's now my primary exchange. I use it as opposed to BitGet, which was my primary exchange for a few years there. This is my primary exchange, and I use it for various reasons. It's never been hacked before. It's very, very low in trading fees. It's global, non-KYC. You don't need a VPN to sign up to it. You don't need a VPN to use it. That's very, very rare nowadays and becoming increasingly rarer. So if you're interested in that kind of stuff, guys, the link is down below. You can get a 15% trading fee discount exclusively with my referral link. So go ahead and click on that link, sign up. It takes 15 seconds. You just need an email address and a password, and you'll get that discount exclusively with my link down below. You help out the channel and you help out yourself. Guys, thank you for watching. Hope you enjoyed. I'll catch you soon.